Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, December the 16th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Some economic data out this morning. Industrial production came in lower than expected. Capacity utilization was also slightly lower than expected. The big thing today was crude oil inventories was expected to be a little bit of a drawdown and came out $4.8 million barrel build. So that was a pretty massive jump. If you remember, last time we talked, it was a negative 3.6 million barrel drawdown. So that kind of sparked me into getting into some long oil and oil related products. But with this big build today, I'm looking to get out of some of these oil related products, and we'll go into that in a little bit. But as you can see here right now, the NASDAQ, E-mini NASDAQ chart, we're down just barely in the negative territory, about 1.5 points. The E-mini S&Ps are positive. So a little bit strange, we've been talking about how the NASDAQ has been leading up to the upside and been the lagger to the downside. Today we're seeing a little bit of change in that, where the NASDAQ is leading to the downside with the rest of the equities still in positive territory. Yesterday, if you remember, I was talking about that the E-mini S&Ps were going to go up into this 44 area because that was the value area, and as you can see, it's done just that. It's rallied up there and kind of gotten quite comfortable in that area. Caterpillar. So Caterpillar, I was looking at, it's just been a downward spiral for this stock in the recent months, but it's kind of found a little bit of a range, and I think that it was good time to put something on here. As you can tell, we have high implied volatility right here, and I was looking at this stock as for the downside, but I decided with the implied volatility, only about 30 days to go, I was going to throw in a strangle. I don't have very many strangles, plus this helps me keep my neutrality to the deltas. If I can add some short deltas and long deltas to neutralize that exposure, that was going to be the best thing for my overall portfolio and still be able to add something to it. So in Caterpillar, I did the January 72.5, 60 strangle, and that's the 72.5 calls and the 60 puts. Selling both of those, that creates the strangle. Collected 93 cents for that strategy, so I sold it for 93 cents. It is undefined on both sides, but I was looking at it as the 72.5 area being a nice little resistance area. It has popped through there before, but the overall market is bearish, so I got a little bit tighter on those and then went pretty far down on the 60s. So they were giving me a little bit more premium for those puts because of this downward spiral and the panic that's going into that stock. So that's the first trade I did this morning. The other one I took off was this OIH, and because of that oil inventory number, if oil continues to go down, the oil services sector is not going to do that well. So I decided to cover this for a loss and had on the January 26-28 put spread, and had originally collected 65 cents for it, had to buy it back for 75 cents, so I lost a dime on that trade. I've had volatility kind of expand on that a little bit. Volatility had expanded on that a little bit, and once it started coming down, it was looking all right yesterday, but today that coming out, the directionality of that trade has hurt me. volatility's helped me, but the directionality hurt. So I decided to get out of that trade. Lululemon. I'm looking at adding a little bit more to this Lululemon. As you can tell, it's in a bearish divergence for the most part. So with Lululemon, I originally, I'll have to check my notes. What did I do in Lulu? I had done the 50-55 call spread in there, and it's rallied up against me and tested my 50s for the most part. So I'm looking to add a little bit to that and doing the 52.5 55 call spread. So I'm going to look to add a little bit to that if I get any bit of a push up, but it's right up against that 50-day moving average, and it's going to act as resistance on there. So that might be a good time to add a little bit to it, not doubling down, but adding a little. Now, the last thing that I have to talk about is Oracle. We have earnings today, and as you can tell right here, the market maker move is $1.88. So I'm going to kind of go about doubling that to $4 out on either side, which if you remember, when you go out on these, we're going to look at like the 10 delta or the 15, somewhere between the 15 and the 10 delta. I've done several webinars on earnings trades, so you can go to protraderstrategies.com and get all the rules around that. But if I look at doing the double the market maker move, that kind of puts me at about the 42-ish area, 43 area. So I'm going to try and it looked a little bit better this morning, to be quite honest. The December actually, and if look at the double the market maker move, which is going to be the 42.5, probably come in a little bit tighter than that and try and do the 41s. And then on the downside, I'm going to be looking at the probably the 34s on this. So I may have to go in a little bit tighter and go into this 35.5 and maybe the 40s, which is still outside that market maker 40.5, which is outside that market maker move. That's going to be a game time decision in the afternoon to see if any of that premium goes up. Usually around the earnings, we're going to get a little bit better implied volatility percent right here. As you can see, it's only around 75. But if you get that volatility crush, which you will right after the binary event, you're going to see this volatility crush as it's done several times before. So, and it has a history of making about $1.50 to $2 move after that earnings announcement. So given that, I might go a little bit tighter. So we'll have to see. That's going to be a game time decision, like I said. Friday's webinar, we're going to be doing another webinar on supplementing options for stops. Now, if you haven't seen, NYSE is getting rid of stops, so we're doing a several-part series on how to replace those stop orders with options. This one's going to be on the collar, which is buying a put and then financing it with a call. So it's kind of like a limit order and a stop order at the same time. So that should be a really good one. I like that one a little bit better than just buying puts outright, but you'll have to find out what the rules are with that going forward. And that's all I got for you guys today, other than if you can't take that, take it easy.